Welcome back to the Market Insights webinar. This is Kevin Prince. We're so delighted that you attended this session one more time, and we look forward to giving you some pretty good insights this time in around banks. So with that, let's get into it, because really it's been your content and your questions that help drive this. And we've had a number of questions around banks recently, and we thought, let's put a topic together around that. Now, when you look at these sessions, think about these sessions as not advice and not recommendations, but market insights and some guidance to help you in how to educate yourself, plus learn about the markets and what to think about when you look at evaluating an ETF in the marketplace. So with that, let me introduce my guest today. I'm going to welcome in Chris McKinney. Thanks for coming back. He's a portfolio manager at BMO ETFs. Also welcome in Mackenzie Box. Once again, thanks for coming back. She's one of our product managers at BMO ETFs. And as I mentioned off the bat, our topic today is around banks. But before we go into that, we always want to share a tool with somebody. And we had a couple questions today coming in around volume around ETFs. So I thought I'd go to this as a tip and a tool for individuals out there. When you're looking at volume on a particular system, and quite often a lot of the discount systems out there, let me highlight most often they're showing just the TMX volume. And if you don't know this, we have a whole show on this already, and you can go look at it on YouTube. But what I'm trying to highlight here is there's more than one exchange in Canada. There's multiple exchanges in Canada. So quite often when you're looking at the volume of an ETF, especially on a discount brokerage site or maybe like a Yahoo Finance, you're not seeing the full picture. If you want to see a full picture, there's a few websites out there. One, for example, Stockwatch. It got a bunch of good news and information anyway. But what I like to do is go here, put in the ticker, and I'm just showing an example here on ZWB. And what you're seeing here is you're seeing all the other exchanges start populating, and you're seeing the flows in the exchanges. So nice little tip for you. If you're looking to see what the true volume of an ETF is, and you want to look across exchanges for that, simply just go to stockwatch.com, type in your ticker, pick Canada, CA that is, and off you go. With that, let's get into the core content. Really, we're seeing coming up next week, the bank earnings season starts. We had some questions in. We thought, you know what? Let's take the time and effort and let's dive into banks earnings, give you some insights on the ETFs out there, of course, and then what for you to think about when this bank earnings season comes out and start thinking about the factors itself. Now, one of the key things to talk about right off the bat is rebalancing. Now, if you're thinking about holding banks or any kind of securities, one of a nice little tip or thought process out there is think about rebalancing on a regular basis. And what I showed you here right off the bat is just took 6 banks and I went to stock charts and I mapped this out and just laid in each year, 2017, 2018, 2019, and 2020, of course. And each one of the color codes down below represents a separate bank. For example, the black one represents National Bank. What am I trying to highlight in the context of rebalancing? But look at 2017. National Bank had a real good year in 2017. So through a rebalancing approach, of course, you're taking some of those profits and you're redeploying them in other areas, which actually worked out really well for 2018, for example, because it didn't have a strong year and the money went to other parts of the marketplace. Same thing too, if you look at 2019, you would have moved from 2018, you would have put back into that, into National Bank because of rebalancing, and you would have had that flow in 2019. But it doesn't always work all the time, to be fair, because we would have probably trimmed a bit in 2019 and then go into 2020. So really what you're seeing here is there is some benefits to rebalancing by trimming off your winners and redeploying to the people, the parts of the market that didn't do as well. Now, certainly it doesn't work all the time, but it tends to be a good way of looking at holding a certain sector. Now, hey, Chris, I know we have an ETF that does rebalancing twice a year. I'm showing you annualized rebalancing. Why does it do twice a year? Can you give me some insights to that?
Sure, and this is work that's been done by actually probably the majority of the large index providers out there. There's always a question when building an index as to how frequent the rebalancing of that index will be, whether that's quarterly, semi-annually, or annually, or even monthly potentially. And when you're thinking about the frequency of rebalancing, you always have to weigh the turnover and potential transaction costs associated with that rebalancing. In short, trading less is better than trading more from a cost perspective. So you want to weigh that cost against the benefit from making that rebalance. And so you kind of outlined what those benefits are. You're tending to sell those stocks that have outperformed and then buy those stocks that have underperformed. So there's a little bit of that sell high and buy low approach built into it. And, really, again, the major index providers have all done the work on this. And for equal weight portfolios, what really came out is that a semi-annual rebalance really is the nice sweet spot between providing those benefits of rebalancing, but also minimizing the cost and turnover related to that rebalancing. And so it was found that quarterly rebalancing just added more cost without really adding too much more in terms of the overall total return. And so the semi-annual is what kind of came out as that sweet spot between providing the benefit of rebalancing and minimizing the cost and turnover associated with that.
Chris, that's why we have you on this, that additional insight. Thank you for that. Let me stay with you for a sec, because some of the terms are going to bounce around here are equal weight, market cap, because there's different approaches for holding sectors in the marketplace. Can you talk to us about the different approaches here, Chris, and maybe when and where to use those?
Sure, and I think everyone's familiar with that market cap weighted approach to indexes and to ETFs. Obviously the large broad indices like S&P 500 and the TSX Composite are market cap weighted. And so what that means is the largest companies get the highest weight in the index and in the portfolio of the ETF that tracks that index. And that makes a lot of sense, particularly for broad multi-sector type strategies that liquidity is of utmost importance, because generally the larger caps have higher liquidity. But when you start to look at a bit more narrow, whether that's a sector or a section of the market or a more narrow investment solution, such as the banks or any particular sector, you really want to start looking at potentially other weighting schemes. And the reason for that is if you take a look at a market cap of a very small, narrow sector, quite often what you'll see is that 1, 2, or even 3 companies tend to dominate that overall index. If you look at industrials in Canada, by a market cap basis, there's really only the 2 large railroads. And so if you had a market cap approach to Canadian industrials, you would really just have 2 companies in there driving the majority of the returns. So, we think investors that are looking for ETFs are actually looking for diversification across the sector. And that's where equal weighting comes in, providing sort of an equal exposure to each company within that sector and diversifying away from that concentration risk. Certainly if an investor was favorable on 1 or 2 particular stocks, we think they would prefer to just go and buy those stocks directly rather than buying an ETF that is largely weighted to those stocks. Investors looking for a sector ETF, I think, are looking for that diversification and want exposure to the sector as a whole. And so that's where equal weighting starts to make sense, again, when you're looking at those narrow type investments. And the other thing this chart shows at the bottom here is the different types of exposure you're getting with an equal weighting approach. And, each of those sectors below, I think we have consumer staples, energy, and financials. You'll see they all tilt towards, a smaller size. And that makes sense because the smaller companies that in a market cap weighted index would have a small weight will have a higher weight in an equal weight index where each company gets equal representation. So you do have that tilt towards the smaller names. That gives you a bit more growth potential as well. So it does also depend on what you're looking for in terms of the return you want out of the portfolio, which weighting scheme you might want to use.
Thanks for that, Chris. Now, Mackenzie, I'm going to bring you in because Chris mentioned, of course, in the ETF context, why would somebody use an ETF to access a certain sector of the marketplace? Give us some background around that.
Sure, and thanks, Kevin. I think when it comes to investing in sectors or subsectors like Canadian or US banks, ETFs really stand out as a great tool because it gives you that instant diversification to a basket of securities. Whereas, if you're doing it yourself, you're kind of putting all your eggs in one basket. And here I include a quick screenshot of the current price of BMO stock, which is $97, and to do a board lot on that, you're just shy of $10,000, and you're only getting exposure to one bank. Whereas with an ETF, you get exposure to all Canadian banks, or if you want to go broad, financials, whatever it may be, you're really getting a more diversified portfolio to that sector or subsector. And the other benefit with ETFs is that most of them actually pay a monthly distribution. So they're giving you a more dependable income, whereas a lot of the banks pay a quarterly dividend. So by using an ETF, you can choose to take cash on a monthly basis. So we kind of just smooth that out. Or if you want, you can choose to have it reinvested and take advantage of the drip as well.
Thanks, Mackenzie. And there are a few choices out there when it comes to ETFs. Maybe you can talk to that a bit briefly here.
Sure. And here's just a quick snapshot of the ETF Marketplace. This is specific to banks as a whole. So if you're looking more broader, there are some other ETFs out there, but when you look kind of zone in just on the banks, there's a few ETFs. So I've included here RBC and a new one that was launched by Hamilton. That one's still relatively new to the marketplace, so there really isn't much data available yet. And the BMO ETFs, those are equally weighted. And Chris kind of alluded to the equal weight approach earlier. And RBCs actually they don't use a traditional market cap, they actually use a yield weighted approach, which is generally more of a value play. And often with this approach, it's more beneficial to the underperformers. So there are a few different options out there depending what you're looking at. It's just important that if you are looking at various ETFs to really understand the strategy and understand the holdings and how they're weighted.
Well said. Always do your homework. Absolutely. Hey, Chris, now let's dive into the actual Canadian banks as a sector. We're going to spend some time on U.S. banks too for those out there listening on. We've certainly seen some performance pickup lately. Talk to us about what's going on in Canadian banks.
Sure. And this chart here shows just year-to-date performance of the Canadian banking sector, which is the blue line, relative to both the TSX Composite, which is the red line, and the S&P 500 as well, just for context, being the green line there. And, it's quite obvious looking at the chart that coming out of the sell-off, the Canadian banking sector didn't really perform as well on a growth basis relative to the broad markets. And, there's a couple of reasons for that. First of all, obviously, concerns around commercial loans. So as we were living through, a significant lockdown earlier in the year, questions around what reopening will look like, and we've been living through this sort of fits and starts of the reopening process of our economy. There is genuine concern around if a lot of those smaller businesses will have the liquidity to make it through to the other side of this pandemic. And of course, if there are company bankruptcies and things like that, it tends to be the banks that are holding the loans on there. And so that was the primary concern coming out of the market bottom that kind of held down the Canadian banks' performance relative to the broad market. You can see in the last couple of weeks or so with some positive news on the vaccine front, that really has started to lift the Canadian banks, and they've come back generally to what the broad market's doing. Maybe just one other point there is that the broad markets, even though, again, we're using the term broad market, the growth coming out of the bottom here in both Canada and the U.S. has been very narrowly focused. In the U.S., it's primarily the tech sector that has been driving that performance, and things like financials, energy, and industrials have still lagged and are still below their sort of pre-COVID highs. So, when you look at the broad market, you got to realize that it is, again, a fairly narrow leadership. And similar in Canada, it's been the gold sector leading that index higher, as well as the IT sector, and really that Shopify in the Canadian market. It's really just the one company. But outside of gold and tech in Canada, you really haven't had much of a growth from the lows either. And so again, now that we have a little bit of a light at the end of the tunnel, so to speak, on the vaccine front and the potential reopening in 2021 of the economy much more broadly than we're experiencing now, Some of those concerns around liquidity are being alleviated, and the Canadian banks are responding with some stronger performance very recently.
Appreciate the insight again there, Chris. Now, one of the bigger questions we get in there, Chris, I'll stay with you for a sec, is dividends, right? I mean, a lot of people reach for Canadian banks because stability of dividends. We saw some noise of some of Laurentian. Talk to us about dividends and stability of dividends in Canadian banks.
Yeah, and we think this is usually a pretty good indicator of future performance of the Canadian banks, because as you say, their dividends tend to be fairly stable and tend to grow over time as well. In fact, it looks like the Canadian banks would potentially even be raising their dividends through this period, but they've been asked by the regulator to sort of hold off and keep their dividends, let's call it status quo, for the time being until the pandemic's over. The benefit of that is that the capital position of these banks is actually improving right now because they're not paying out additional dividends. They're really just improving their overall balance sheet. But as I mentioned, looking at what the dividend yield is on Canadian banks tends to be a good indicator of what the performance will be going forward. And as you can see by this chart, there really hasn't been many times in the last 15, 20 years, you can even go back much further than this chart, to a point where the Canadian banks on average were yielding over 5% on a dividend basis. We can see obviously one time back in 08, 09 when the yield spiked higher than that. And if you had bought at that time, you'd be doing very, very well right now. And so we think similarly right now, if you can start your investment with a 5% dividend, particularly for income-oriented investors and investors in taxable accounts, the tax effectiveness of that dividend puts you really well ahead. It gives you a really good head start to a total return when you're buying with a 5% dividend. Last thing I'll mention here as well, again, the Canadian bank dividends do tend to be very resilient. They did not cut them through the financial crisis. Again, they haven't cut them here, and if anything, would be raising them if they were allowed to. And, one other note we put on this slide here is that, all of the major Canadian banks have been paying their dividends since at some point in the 1800s. 1823, I think, was the earliest we saw a bank paying the dividend here in Canada. And so a very, very long history of banks paying those dividends. So in terms of what you're getting, we think that's a very stable base to start growing that dividend from. And of course, you get potential growth coming out of that as well. So a 5% dividend plus the growth potential, we think is a great place to be starting for yield-oriented investors.
And agreed. And I think what we were saying is the major Canadian banks haven't done any cuts in dividends for some time. And that's the focus of this chart here. Let's dive into a little bit more, because that earnings season kicks in next week. And Chris, as a portfolio manager, what should people look into consideration as that earnings season comes in?
Yeah, it's going to be an interesting one here. Of course, we saw major downswing in earnings per share a couple of quarters ago, and we've seen some rebounding there. So it'll be interesting to see, what the Canadian banks come out for. But three things really that I've just listed here that we want to keep an eye on as investors. Again, first of all, is that earnings per share and the improvement of the year over year comparison. So if we go back to fiscal Q2, which was really right in the heart of the lockdown in March, March and April, fiscal Q2 earnings per share were down 50% on a year over year basis on average for the Canadian bank. So obviously a very, very negative year over year performance in terms of earnings per share. In the quarter following that, in fact, I think the banks surprised most investors by the year-over-year earnings only being down about 20% on average. So we've seen some rebound from that trough of a minus 50, now down to about a minus 20 in the last quarter. And what we would expect for this quarter coming up, as you mentioned, starting next week, is to be a slight improvement on that minus 20 year-over-year. We think maybe 15 to 20% on a year-over-year decline. Again, is a positive news in terms of a little bit of stabilization and a little bit of returning to normal. We think that would kind of indicate that the bottom is behind us. and there's only improvement going forward. Similarly, the other thing we want to look at is those loan loss provisions. So, as I mentioned previously, banks obviously have exposure to a wide variety of commercial loans, and they put in what's called PCLs, or provisions for credit losses, and that's their estimate of how many of those loans are going to go bad. Typically, if you look historically, the best time to buy the banks is at the peak of their loan loss provisions. So that kind of signals, the worst is being baked into these prices, and it's only, getting positive from there. Of course, you don't know what the peak in loan losses is until after the fact, because you have to have a couple of quarters of reporting before you can see where the peak was. But looking at what the numbers have been, we do expect the peak was in that Q2 when earnings were down 50%. A significant amount of loan loss provisions came from the banks. Prior quarter, again, they actually surprised investors by not having as much loan loss provisions in their earnings as analysts and investors were expecting. And so we would expect that again this quarter to see a slight improvement there in loan loss provisions. And again, historically, the peak in loan loss provisions would be the ideal time to be investing in banks. And so if you see another improvement this quarter, we can be pretty sure that that peak is behind us. And again, that it's kind of more positive going forward. And then, of course, the last thing we want to look at is just what the outlook is for 2021. Obviously, very, very hard to predict what will be happening over the next year or so with reopenings and when vaccines get distributed, how quickly economies reopen on the back of that. So it'll be interesting to see what the forecasts are and what the banks are estimating for growth going forward. So those are kind of the three things we want to look out for as earnings start next week.
Yeah, appreciate the insight again there, Chris. Chris, you also put a quick slide in on valuations. I think you already talked to valuations, look relatively attractive. What I want to do is I want to shift gears and I want to talk about US banks if we can, and get your insights on that side, relative performance there recently.
Certainly, and this chart looks pretty similar to the one we put up before. US banks underperforming the broad market, coming out of the bottom in March and April. And again, the reasons around that is that the banks are exposed to that economic growth. And if growth is not very strong, the banks might not perform very well. But really what we've seen here in the US is, when Jerome Powell gave his speech at the Jackson Hole Symposium in August, they kind of referred to the new calibration of the Fed in terms of their inflation targeting. And they essentially said that they will allow inflation to run above 2% for a considerable period of time in order to average out to 2% over a period of time. And so what that's really done is started to steepen the yield curve. Investors think right now, oh, well, rates are low, that's bad for banks. But it's really only short-term rates that are very low right now. And if you think back a year or so ago, we were talking about a flat yield curve and an inverted yield curve. Right now, since that August, speech, the yield curve has gone up about 40 basis points in the U.S. The long rates have gone up about 40, 45 basis points. And so we're seeing a very strong steepening of the yield curve. And that tends to benefit the banks because they lend out long duration assets and get that higher interest rates, and then they borrow at shorter term rates, and that's how they make their spread. So it's been a positive situation for U.S. banks, and you can see the performance there recently picking up again as well with some positive vaccine news. But the U.S. banks have actually caught up about 15% relative to the broad market since the end of August there. So again, we see a little bit of positive momentum here, positive environment in the economy. And then the last point there as well, through the U.S. election, with potentially a positive outcome there with a split Congress, there's an expectation that there won't be significant regulation on those banks going forward down in the U.S. And so again, another tailwind to potential positive performance going forward.
And Chris, just talking briefly about the U.S. bank valuations, give us some insights on this.
Yeah, and this is, primarily for Canadian investors. The first thing we think about is Canadian banks as to where we want to invest if we're looking at financials. But it's always good to take a look at the valuation of Canadian banks versus U.S. banks. And what this is telling us is that it's, pretty much on the lower end relative to the last, 15, 20 years of data, maybe 15 years of data or so. We're kind of on the lower end of where US banks are valued relative to Canadian banks. And so, from a valuation perspective, you might say US banks look a little bit more attractive. That might mean there's a little bit more growth potential coming out of them. But conversely, they're not paying as high of a dividend. So again, we had that dividend slide earlier on the Canadian banks. A 5% dividend, again, a strong place to start from. So you're getting a little bit higher dividend upfront with the Canadian banks, and you're getting a little bit more growth potential, potentially from the US banks. So this is what we're looking at to get a sense of, what to expect out of each of those two sectors.
Perfect. Mackenzie, let me bring you in here. I want to talk a bit briefly about currency considerations, because you can buy ETFs in Canadian dollars and US dollar exposed. So talk to us about that, what that really means.
Yeah, sure, Kevin. I think currency is always an important decision. You always want to be mindful if you're looking beyond Canada and you need to consider the total cost. So, is the investment in a different currency? What's the local return? Is it hedged, unhedged? These are all things you want to be mindful and make sure that you understand how that impacts the total return of your investment. So, depending on your views of currency, there are many options out there, like Kevin alluded to. You can go unhedged, hedged, and in some cases, US dollars. So there's multiple options out there. You just want to make sure you understand where everything's coming from and how it can actually impact your return.
And thank you for doing this too. You kind of highlighted too in your currency slide here that there are different times you want to be in different currencies. And that's a nice benefit of Canadian ETFs, is that you do have that choice of exposing yourself to currency or not exposing yourself to currency. Chris, also in the Canadian ETF marketplace, there's not just, of course, the normal ETFs on banks. There's also some cover call ETFs. And I thought we just have to take a few moments here and just talk a little bit about the trade-offs. And let me help me through the trade-offs here. So what I'm trying to highlight to the audience here is effectively metrics around what's behind the scenes of a cover call ETF. And Chris is one of the guys who put together this metrics behind the scenes and kind of helped us, give a talking point here. And what you're seeing here is percentage cover first and foremost. You look at the ZWB and see that percentage coverage, and it's 50%. So Chris, by saying 50% covered, what does that really mean?
Sure. So with a covered call strategy, what you're really doing is trading away some upside potential for current income today, or for current cash flow today. And just as an example, if you look at the bottom, we have a couple of tickers there. On the left is ZEB. It shows a distribution yield of 4.8%. That's our equal weight banks ETF, so that's basically the dividend amount. The ZWB, the one right beside it, has a distribution of 6.6%. So you can see the difference there in terms of the distribution and the income that you're getting from a covered call strategy. And again, what you're trading off for that is some upside growth potential. And so when you're looking at percent covered, that is telling you how much of the portfolio is making that trade-off. So how much of the portfolio has their growth capped? And in essence, when you look across these strategies, they're all right around 50%. So that means, half of our covered call portfolio is going to just enjoy all the growth that we see in the markets coming out of those banks. The other half of the portfolio is capped after a certain level. And that's what the moneyness is telling you. So again, in the case of ZWB, if you go to that next column over, it says out of the money is 5.4%. That means the portion of the portfolio that's covered with call options can still move up on average about 5.4% during the life of these options before that growth trade-off is being capped. So in essence, your entire portfolio has that 5% growth potential baked into it. And then half the portfolio will continue rallying should banks move beyond 5%. And generally, these are 1 to 2 month options. So that gives you a time frame for what that moneyness number gives you in terms of growth potential over the following month or two. So that's really the trade-off you're looking at: more income today, less growth potential going forward, and that chart really gives you an idea of what that trade-off is. How much extra income am I getting, and what's the trade-off in growth that I'm giving up?
Thanks for that, Chris. It's also good to see that you're earning the full income behind the scenes, and that, of course, covers up that monthly distribution there. Now, I'm going to shift gears here. I want to just cover off some of the questions that came in this week, and we got a bunch of questions. Hopefully get through most of them. And I really, one more time, appreciate you spending some time and sending those questions in. Chris, staying with you here, ZW, a cover call utilities, and ZPay. What's some of the differences there?
Sure, and so ZWU is one of our we'll call them standard covered call strategies that invest in a mix of both Canadian and US listed utility stocks, but also telecoms and pipelines, so those utility-like sectors. And so we have a nice base of those somewhat conservative type of investments. Again, the telecoms, like BCE and Rogers here in Canada, some of those utility stocks and some of those pipeline stocks as well. And so it's a fully invested in the equity market, and we run that covered call overlay to increase the distribution yield on that to generate that additional cash flow like we were talking about in that last slide. ZPay is our premium yield ETF, and that one's a little bit different. First of all, it's only US markets with the underlying, so you're getting a different exposure. You're getting exposure across all sectors, not just those utilities and quasi-utilities. But the other thing that's different about this strategy is that it relies more on writing put options to generate cash flow rather than being invested in the equities for growth. So there is some equity investment, but it tends to be more around 1/3 of the portfolio is invested in equities versus ZWU, which has pretty much 100% of its portfolio invested in equities. And so ZPay is more, the objective is more reliant on the income stream coming from the options to generate the return versus ZWU, again, that has more growth potential because it's a higher weight in the equities. So ZPay should be a little bit more less volatile and should give you more cash flow from the option overlay that we're running on that strategy. And again, a little bit different underlying portfolio as well.
Thanks for that, Chris. And I really appreciate the person who's taken the time to become an educated investor on this. That's great. Now, let me come to you, Mackenzie, because we talked a little about the exchange volumes in the opening tools, but talk to us about concerns around low volume in, for example, ZPay and of course ZMID. Give us some insights on that and what people should look for.
Sure. So first, I just want to highlight on our website, we do show a consolidated volume quote. So if you are ever wondering where to find volume, you can find it on each of the product pages. It's right on the main tab there. So look there if you're looking to find volume numbers. And the other thing I want to just highlight is that you always want to look at the spreads. That's probably your best indicator of liquidity, not volume. And these ETFs are part of larger ETFs as well. So, ZPay is over $300 million ETF. So, they are large ETFs. And if you are concerned about some of the lower volume, I would just then go to some of the spreads to give you a better indication.
Thanks for that, Mackenzie. I always think you're right. Look at the spreads, not the volumes, because you're probably not seeing the right data set with the volumes anyway. Hey, Chris, let's talk to you about this a bit here. So individuals taking a look at our Canadian banks and look at the ETF and the fee out there. Just is it the convenience to buy this ETF? What do we get out of this ETF?
Yeah, and really, each of our sector funds, we do tend to look at the equal weight approach. And so again, we're following an index here. And really what we're trying to do is provide an efficient package for investors to get access to, again, the broader sector rather than just one or two companies. So, there's always a trade-off to be had, and there's always a calculation to be made when you're looking at any ETF really is how much would it cost me to get this exposure on my own through, buying all these stocks and paying the commissions associated with it, et cetera, versus just buying this one ETF where I only have to buy one line and then all the rebalancing and everything that goes into it is taken care of as well. So, if you think about even just the Canadian banks that only have 6 holdings in the ETF, to buy 100 shares of each of those, Mackenzie, I think, mentioned earlier on, you're looking at close to about $10,000 per name to buy a board lot. And so, building out a portfolio of 6 banks, you might have to have, $40,000, $50,000, $60,000 just to allocate just to the banks. And so, if you have that amount and you're happy to make those investments on your own, certainly that's the best way to do it. And of course, remember, you'd have to monitor that and rebalance it every once in a while also, which would incur other transaction costs and things like that. But for the most part, a lot of investors think, I know what's in this. I know I could do it myself, but you know what, I'm just going to pay one fee, I'm going to buy one thing, and it's going to take care of the rebalancing for me. And so that's really what the ETF is providing, is that efficient package to gain access to the sector and get instant diversification.
Thanks for that, Chris. And Mackenzie, probably have time for one more question. Let me close out with you. Individuals thinking about ETFs short-term or ETFs long-term, what's it best suited for a retirement portfolio?
I think the answer is it can go either way. There's lots of great spectrum of long-term investments that you can look to. If you want to just hold the market, we have broad market indexes that you can invest in. And then, if you have a certain view of a sector, or there's a certain view that you have, or you want to overweight and be a little less conservative, or you want to be more conservative, and you maybe want to turn to low vol. There's multiple ways you can do it. So I think the answer is, if you have short-term views, you can tactically use some of our ETFs. If you have long-term views too, you can build your foundation with ETFs as building blocks to be a long-term hold for you as well. So depending on your objectives, depending on your view, you can kind of go either way.
Thanks for that, Mackenzie. I have to agree. That's why we're in the ETF business. Hey, I'm going to encourage everybody to come join us next week, because in next week, we're going to spend some time and we're going to talk about advocacy. And what I'm really talking about here is the voting that is going on the ETFs themselves and in the overall market itself too. There's certainly a key consideration around that, and that key consideration now is around that ESG aspect, right? The environmental, the social, the governance. So we're going to spend some time next week, dive into the advocacy, give you some insights around that. Hopefully you can join us on December 4th, one more time at 1 o'clock. And between now and then, please send us your questions. Thank you so much for your participation. Have a good week ahead.